Good day to everyone, and thank you so much for once again tuning in and taking the time to further develop your trading skills and your trading knowledge. Today, I have a very wonderful video that's going to teach you more about the bullish markets in detail. If you ever wondered what it really means when traders say the forex market is bullish, whether you're brand new to forex or just brushing up, your market knowledge, understanding basically the bullish trend is essential to your trading and your trading journey. So in this video, we're breaking down the basics of a bullish forex market, what causes it, how to identify a bullish market, its participants, its behavior and characters, and most importantly, how to take advantage of it. We will also show you real world chart examples in future once you understand this fundamental basic understanding of the bullish market. So if you're ready to learn how to ride the wave of rising prices and grow your forex skills, please stay tuned. I'll go through each slide with you and I will give you the most basic explanation to better your understanding. So a bullish market in Forex means the price of a currency pair. Remember currency because we're trading the Forex or the foreign exchange market. So when the currency pair that we're trading is going up in price over time, or it's increasing, or it's in an uptrend, we call this bullish because just like a bull attacks by thrusting its horns upward, a bullish market is also about upward price movements. So let's look at the first slide and look at the opening question as to what is the bullish market and more information about the bullish market itself. The term bullish resembles the bull horns, as I explained, when it's thrusting its horns upwards, the strength that pushes up when a bull strikes. A bull market is a condition of a market where the prices keep rising or are anticipated by traders to rise continually during this time. Traders have expectations of the markets changing its character or its direction and moving to the upwards direction with prices increasing. We consider a market that continually increases in price a bullish market. Within a bullish market, we will only look for buying opportunities on a short-term or a long-term time frame. The bullish market indicates a strong currency in the foreign exchange markets, or we'll say a currency pair because we'll be looking at two currencies against each other. On that particular market, if the trend is bullish or the prices are increasing, then the currency that we are looking at will be a very positive and strong currency. We can visually identify a buying or a bullish market just by reading technical and interpreting fundamental data of a currency pair that further aligns us to participate in buying trades and take buy trades to make a profit. The bullish market, further to this, has its own set of behavior and conditions. In this module, we will talk about the conditions of a bullish market, the natural behavior of a bullish market, and how to read and understand a bullish market in the most fundamental and technical view. As I said, we're going to progress into the charts once we have completed the study guides. So let's move on to the bullish market participants. With participants, it's referred to all traders in the market at that current moment. So it is a very good topic because the bullish forex market has several types of participants that help drive the price upwards or the trend upwards, each with their own goals and strategies in place. And a quick breakdown will be central banks and governments. Their role is to manage monetary policies. Banks, what do they do in the markets? They set interest rates, they intervene in currency markets when necessary. In a bullish market, if the central bank were to cut rates, It would be positive for the economy because it's going to be driving more lending and more spending of money. So it will signal economic growth. Also, if the interest rates are increased, it attracts foreign investors because if they invest their money, they know that the money that's being invested will come back with a high return based on their discount rates. So institutional investors would be mutual funds, your hedge fund banks, pension funds. They move huge amounts of money. So their buying activity has a strong influence on the markets. And in a bullish market, they spot an opportunity, they start buying and help drive the trend upwards. There are footprints that are left on the markets, areas where we can see where bullish activity had been taking place or the market had been buying. And those big moves are caused by fundamentals or are caused by these guys, the institutional investors. So in most cases, when we are looking for buy trades, we're not fortune tellers now. The market tells us or shows us where previously where there was buying activity. So we can identify areas where we know that there was institutional trading or institutional movements, and we'll wait for the markets to revisit those key areas where these big players had made buy trades and further take buy trades on those areas. Retail traders, individuals like you and I, beginners, semi pros, professionals, trading through platforms like MetaTrader or TradingView. In a bullish market, many retail traders join the trend once they see confirmation. We don't start the trend, it's the big boys who start the trend, and then we follow the trend just by looking at the behavior of the market to determine that it's now bullish. Commercial companies who are importers, exporters, multinational corporations, they also impact the markets, but I just want to look at the three important ones. Now, anyone who opens a buy trade is participating in bullish activity. The best time and the only time for you to buy or open a buy trade is in a market that has bullish conditions. By markets, we're referring to our chosen markets, which is the foreign exchange market. So, for example, as traders who trade the foreign exchange market, when are we going to buy? We're going to first pick a pair, the two currencies. Euro will be the first one, and the second one will be dollar. Or we'll pick it off the MetaTrader 5 app or TradingView. It's already there. We don't code them ourselves. They already codes it for you. You just pick a pair. So we pick Euro versus the United States dollar. If the Euro USD is showing us a bullish market with the trend being bullish, it's moving towards high prices and only remains in an uptrend. We can then consider this a bullish trend or a bullish condition. The bullish market also has selling activity, but this remains very limited for a short time, and this is just the market readjusting itself. So the market will first buy, which is caused by the big players or the big boys or the big wallets. And when the market is buying, it starts moving up in price, or the direction starts going up. When it has bought and start going up, the market can't continue going up. There must be a pause. It's like breathing. You breathe in and you breathe out. When you're breathing out, the market is going up. When you're breathing in, the market pulls back. Just like yourself. When it's pulling back, that's the selling part. It's just a small portion or a time frame where we sell. And we don't want to enter that sell, or when the market is just pulling itself to lower prices for us to buy on those low prices and further go in the trend. That's readjusting. But readjusting is a visual concept. It must be explained to you visually on the charts. It's not a theoretical explanation. I can only explain it to you like this once you've seen it visually. It will make more, you'll have great understanding. So once it's readjusts itself, say now it's when it's going up in direction, starts pulling back a bit just before it further goes up, then we know that it's going to continue moving further up to higher prices than the previous high prices this was trading around before it pulled back. So when the market is moving in a bullish trend, there are strong buyers within the markets who have opened buy trades and more aggressive buyers joining the trend, such as retail traders, which is us. And then you'll have other bigger players as well adding into the market to further drive prices higher. And the trend just continues and continues to the upside until we visit an area where the market once sold, then sellers will enter and they will start selling. So it's a buy and sell relationship. When the market has more buyers than sellers, if 80% of the market is buying and 20% is selling, obviously it will tip the scale. The buyers will impact the direction of the market and the prices will start moving towards the buyer's direction, which then creates an uptrend and the market prices will start moving to the upside, finding new higher prices or visiting previous high prices before it creates newer higher prices. As we move on to the left side at the top, on the right side top, sorry, the bulls. Buyers are the bulls. They step into the markets when the sellers have sold and pushed the markets to an area where buyers have once bought. Sellers will push the market from 5 rands, I'm making an example, which is a high price, back to 1 rands. Then from 1 rands, buyers will enter the markets to create that balance and push prices back up to 5 rand. So we know at 5 rand we're selling, at 1 rand we are buying. That's our buying area where prices were low and we increase them to high prices. And when we sell at high prices, bringing the market down. But selling has its own topic. I'm not even going to talk about it at all. So when they step into the market as buyers, the sellers will then push prices low. And when they are pushed to a low, we are visiting an area where buyers once bought. Then we start creating buying signals, or the market starts showing buying signals, and then we enter the trend. So once the market reaches an area where buyers created a trend to the upside. Obviously, as buyers, they wait patiently for the right time to enter the market and they potentially leave market footprints. Footprints are just areas where buyers once bought, and you can see that on the charts visually to prepare you so when the prices revisit those areas, you can also buy in, which are areas visually available on the charts, as I said, for you to see and use as an area or key level to rebuy the trend that bulls once created. The market itself is a battle between buyers and sellers, or supply and demand. The market only goes up or down, and in times of readjustments, where it's pausing or where it's breathing out, it will then pull itself back or it will move sideways before it continues to the direction that it should be trending in. It will casually move sideways when it's pausing or in a counter trend, which in a bullish market, the market will move upwards for some time and pull back slightly to the downside just before it continues its long term direction upwards, which is bullish, that's up. Trading psychology states that 70% of traders find trading easy and much calming. To be honest with you, this is just some facts I was sharing as well. But as a trader, you won't enjoy both. You'll either enjoy being a bullish trader or you'll either enjoy being a bearish trader. But 70% of traders find trading easy and much calming a if they have a buy position and a trade and sorry and it and sorry if the trader is trading as a bullish trader, then the psychological state shows that 70% of them find it easy and much calming to have a buy position and trade a bullish market or pay. It is less psychologically challenging as well. With that being said, guys, with fundamentals, I just don't want to be competitive, but I also want to push you. By now, a fundamental should be a song to us. We should understand that it's just a calendar that shows us dates of when is economic data published. I even showed you yesterday on the economic calendar that the news that we're focusing on are the ones that have high impacts on the markets. Unemployment rates, that's basic knowledge. Interest rates, inflation rates, those are key indicators that impact the market's trend when we are trading or the direction of the markets. As buyers, we only want to focus on news that impacts the markets positively. hearing stuff like more jobs have been added to the labor market, that's positive. The interest rates being cut or lowered, remember it drives borrowing. People will then want to borrow money because the rates are lower. And when people have cash, just like you, if you think about it, you want to spend when you have money, or you want to save to better your life. So it's part of growth. It's growth. When you have money, you always want to grow, you always want to do what's right. So these economic indicators, or these fundamental news that drives the market's direction or impacts the economy's strength, as buyers, we only want to look at positive news. So the economic calendar is one of the most important tools to use and follow as a trader. Economic data drives the movement of the markets, as I explained. The economic data is just like any other calendar. However, it serves as an economic gauge that helps traders understand the economy of a country and its strength, of course. We find information in data, as I explained, such as unemployment rates, interest rates, inflation rates, and everyday news that can either have a positive or negative impact in the direction of the markets. Once again, if we are looking to buy and win a bullish market, we would be expecting bullish and positive news, or news that creates a bullish environment. Applying the fundamentals, positive news and data indicates to us a strong economy, and bulls love a strong economy. They know that the market condition will be bullish because of positive news in the near future or immediately. The market's reaction will be determined on the charts as to how the news impacted that direction or the strength of that economy. If the market is bullish, it is a positive and good sign, as this means the economy is growing and the demand for the currency is high. So buyers are actively participating and opening buy trades. Positive news also sparks buying positions. It doesn't mean open a buy position, but it can further signal a buying position, because we know now where the direction of the economy is heading. Just like this evening, we're going to have the interest rate decision. Federal Jerome Powell is going to be speaking with the Federal Open Committee this evening, and they're going to discuss the direction or the economy of the US. And we just want to hear hints from him, such as the direction of the economy growing or declining, inflation cooling or increasing, labor, jobs, are they adding more jobs, or are they in a tight labor condition? So his tone, you will also be able to hear a person who's not confident about the economy. He won't be saying good things about it. So obviously, you know that, hey, long term the dollar is not going to be looking very well. So you want to align yourself to start seeing the direction of the dollar going to the downside. So that's what's going to happen. Questionnaire. These questions are for you. I specifically put 7 questions, 7 effective questions, not just 7 questions, but these effective questions to make you understand this. You gotta answer these questions. You can't skip the questions, because you need to test your knowledge. Break session, chart patterns we'll go over when we do technical analysis more in detail, and characteristics of a bull market. Now, the bullish market itself, right, has natural characteristics that forms the natural behavior of the market. The natural behavior of the market is how the market moves naturally. It only goes up, it only goes down, it only goes sideways. That's nature. It's designed and built to only go up, down, or sideways, or go up, pull down a bit, go up, pull down a bit. That's all. Now, those natural behaviors of the market, when the market is in a bullish state, we know that the bulls will enter the market and the direction of the price starts moving to the upside direction. We allow the bulls to create our first high price. Then, before we enter the market, we would see the bulls pushing price higher, directing the market or directing the market price upwards. This is just people adding more buys, people seeing more bullish news, people seeing new higher prices. They want to get in the market. Nobody wants to miss the trend or the wave. Trust me. Everybody wants to make money. Don't even buy for 5 minutes, buy for 1 minute, buy for an hour. Everybody just wants to dip the trend, make money, and get out the market. Simple. So when they are directing the market price upwards, prices will go past the first high price that they create, which we will watch them first creating a high price, waiting for the market to come back to a lower price, and we'll jump in to get into the trend where the market is moving towards that high price they made to show that we are further moving to high prices, which are the footprints that they leave. Now, once that price has been passed, the bulls will form another higher price by directing the market further up. That's now we can then confirm buying activity has started because we keep seeing them creating new higher prices, revisiting lower prices, going further past the previous high prices that they created to make new higher prices than the previous high prices that are in the market. So it's just going up and down. Low price, high price, visiting low price, creating a higher price, visiting low price, creating a higher price, and so forth. Also, when we can see that new higher prices are being created, that is when we're going to enter the market and we allow the bulls and ourselves to be in control of price as they continually drive the market to higher prices after a previous high price has been passed. It now leaves that high price that has been passed as the lower high price, and it continues to make a new higher price. All of this will be visually explained because this is a market structure explanation as to how the market moves up, and when do we know that it's moving up. We need to understand it visually rather than theoretically. So it's important you never caught in the wrong side of the market conditions. You want to buy when the market is buying. You also want to follow the trend because the trend is your friend, and you gotta mark these words. You always gotta follow the trend. This is a self study, just terms that I've been sharing with you throughout the entire foundation course. You need to study these small little details about big events that happened historically as to now us being at this stage when it comes to trading. And further to this, I'll be sharing the bearish slide when I'm done later on this